All right. So we're diving deep today into the world of John Carter.
Oh, yeah, this should be fun.
Yeah, you guys sent in some really interesting stuff about him, and well, he's kind of got this reputation, right, as like a bit of a trading guru.
Definitely. He's got these strategies, these techniques. People swear by him.
And I gotta say, just glancing over the material, some of them sound, well, a little wild, to be
Oh,
honest.
absolutely. Like focusing on just the last 45 minutes of the trading day? Who does that?
Exactly. But hey, that's what we're here for, right? To
Yeah.
break it all down, see if there's anything we can learn from this John Carter, and maybe even steal a trick or two.
You got it.
So, first things first, where did this guy even come from? I mean, econ and history degrees, that's not exactly the typical Wall Street background.
Right, you'd expect, like finance, MBA, that kind of thing. But Carter, he's different. Started out in corporate finance, got bored, took a leap of faith, founded Simpler Trading.
Simpler trading. So is that like a brokerage,
hmm
a hedge fund? What is it exactly?
More like, think of it as education meets trading. Carter's big on making this stuff accessible, not just for the Wall Street guys, but, anyone who wants to learn.
I see, I see. So kind of fits with his whole, history and econ background, looking at the big picture, not just the numbers.
Exactly. And that reflects in his strategies, too. He's all about finding clear patterns, understanding market psychology.
Oh, so it's not all just, black box algorithms and secret formulas.
No, no, no. He's all about making it understandable.
Makes sense. Okay, so speaking of strategies, let's dive into this 21.52 thing. That name alone is just begging for an explanation.
Right. It sounds like some kind of secret code.
So last 45 minutes of the trading day. Why? What's so special about that little window?
Well, think about it. Market's about to close. People are tired, maybe a little stressed, trying to wrap things up.
Oh, I see, I see. Emotions are running high.
Exactly. People start making decisions, not based on, careful analysis, but on gut feeling, on fear, on gotta get this done before the bell rings.
Makes sense.
Yeah.
So more volatility.
Tons of it. And Carter, he figured out a way to exploit that, to use those wild swings to his advantage.
So basically, while everyone else is panicking, he's staying cool and making bank.
Pretty much. But gotta emphasize, this is short-term stuff. In and out, quick decisions. Not for the faint of heart.
Oh, absolutely. And definitely not for folks in different time zones, unless they're really dedicated to those late nights.
Oh, yeah, for sure. Time zones are critical for this one. You gotta be in sync with the U.S. market close.
Makes sense. Okay, so that's the 21.52. Now the TTM squeeze, that sounds painful.
Right, like something you don't want to get caught in.
So this one's for spotting those breakouts, those big market moves, right?
Yeah, it's like, how sometimes the market's all quiet, then bam, huge price swing out of nowhere.
Yeah, those are the ones that make you want to pull your hair out.
Well, the TTM squeeze, it helps you see those coming. Not always, of course, but it gives you a heads up. Think of it like, those pressure gauges on, like a gas tank or something.
Okay, yeah, I'm following you.
So as pressure builds, the needle moves, right? The TTM squeeze, it's kind of like that. It's using these indicators, Bollinger Bands and Keltner channels, to measure market volatility.
Wait, back up a sec. Bollinger, what now?
Don't worry about the technical jargon. The point is, these things measure how much the price is bouncing around. When they get all squeezed together, it means the market's about to explode.
So you're not necessarily predicting which way it'll go, but you're seeing that something big is brewing.
Exactly. Like watching a pot of water just before it boils over. You know something's going to happen, just not exactly when or how.
Got it. Okay, so 21.52 for the short-term chaos, TTM squeeze for the big breakouts. What else we got?
Well, then you've got LOHP and HOLP.
LOHP, HLOP.
Those sound cheerful.
They're actually two sides of the same coin. One's for short selling, the other's for buying. But both are about finding key price points over a set period.
Okay, break that down for me. So picture a stock chart, right? You've got peaks and valleys. The LOHP, it's about finding that lowest point within a certain time frame, like a week or a month. That's your signal to maybe short sell because the price is likely to keep dropping.
Okay, and HOLP is the opposite.
Yep. High of the low period. You're looking for the highest point during a downturn. That could signal a buying opportunity because the price might be about to rebound.
So it's all about timing, knowing when to jump in, when to get out.
Exactly. And to really master these strategies, you got to understand market cycles. Accumulation, markup, distribution, sell-off.
Wait, hold on. Market cycles.
Yeah, it's like the market's always going through these phases. First, people are cautiously buying, accumulating. Then comes the markup, prices rising, everyone's excited. Then distribution, people start selling off, taking profits. And finally, the sell-off, the panic, prices plummeting.
Okay, that makes sense. So
Uh-huh.
the LOHP and HOLP, they're like tools for specific phases, not just random buy and sell signals.
Exactly. LOHP for distribution, when things are heading down. HOLP for accumulation, when they're starting to climb.
Got it. But I gotta say, with all this talk about timing the market, spotting breakouts, jumping in and out, it all sounds a little, well, risky.
It can be, for sure.
Yeah.
But Carter, he's big on risk management. He's always talking about stop-loss orders, position sizing, protecting your capital.
Yeah, that's smart. So it's not just about making the big wins, it's about surviving the losses too.
Absolutely. Even the best traders, they lose sometimes. It's how you manage those losses that makes all the difference.
That's a good point, a really good point. So I guess at the end of the day, what we're learning here is John Carter isn't just about specific strategies. It's about like a whole philosophy of trading.
Couldn't have said it better myself. It's understanding market psychology, managing risk, knowing yourself as a trader.
Exactly. So here's a thought for everyone listening. Where of these strategies, if you had to pick just one, would you try out?
Yeah.
And why? What speaks to your trading style?
Good question. I'd be curious to hear what people say.
Me too. All right, that's all the time we have for this deep dive. Thanks for tuning in.
See you next time.